Let's connect with a corporate voice then. Within the banking space, we've seen a huge catch up with a lot of PSU banks. What is the outlook in terms of the capex cycle, strategy to gain market share, as well as their financial metrics? Let's get all of that answered with Sanjiv Chadha. He's the managing director and CEO of the bank. Thank you so much for taking time out. Good morning. Now, given the fact that we're seeing the overall system credit growth in the mid-teens, take us through how you're looking at growth here.
So thank you very much. A very good morning. So I think we have been seeing a revival of the growth sentiment over the last few quarters. And I think that's something which has now possibly reached critical mass. So if you look at growth, the growth was there as far as retail segment was concerned. Corporate was a bit of a challenge. And that's something that we are now seeing coming back. Partly, of course, it is that there's a bounce back after COVID, but equally, I think the investment cycle that we had spoken so long about, possibly it's now getting triggered finally. And this investment cycle, of course, continues to be powered by government expenditure, particularly in terms of infrastructure, which has got very strong cascading impact on various industries, including particularly cement, steel, etc. But now what we are seeing is that there is a private investment cycle which is becoming more and more broad-based by the day. So to my mind, I think we have reason to be now fairly optimistic that if we were to compare ourselves not only with what happened during the COVID period, but also in the years before that, possibly we are in a much better situation and we should see strong and sustainable growth momentum.
Morning, sir. This is Nikunj Dalmia also joining in. It's the first time I'm interacted with you on this forum, so very warm welcome to you as well. How do you think this credit cycle is different? That's the debate all of us currently are. That's the ongoing debate that a new credit cycle has started. It is different. It's going to be much more powerful.
So I think in part, of course, it is that what is powering the credit cycle. I think there are a number of factors on the demand and supply side which would be supporting it. First of all, as we spoke, this demand for infrastructure, that is something which is very powerful. We have seen, for instance, enormous investments going into road projects. And road projects is just an example because that's where we were able to get our act together in terms of making sure that the lessons from the last round of growth were learned. So now when you fund an infrastructure project, say again, a HAM project, issues that were there in terms of land acquisition, in terms of traffic risk, those have been taken out. So I think that is one part, that infrastructure demand is robust. And also it is a lot of risks for banks are out of that. Number two, in terms of social goods, we have seen again, for instance, in the case of education, that there's been such a large demand for new age companies. So one part, of course, is that who's fulfilling the demand. But the fact that the nascent demand is there, was there, and is something that is going to be addressed in the next few years is something which is important. Third, the consumption story has always been strong in India. That continues. The investment cycle of the government, now I think that's something which is likely to be sustained because we have seen a bounce back in terms of government revenues. GST is finally paying off in terms of all that was done there. Exports remain fairly robust. And again, certain secular factors, say like the energy transition. Now, one is, of course, growth in demand, but the fact that new investments are required for a new category of investments, I think that's equally important in terms of sustaining demand. Now, if you look at, again, on the being buoyant, inflows from FIIs, India getting added to major debt indices, I think all this should really prompt a lot of capital inflows as we go ahead. And domestic savings, of course, I think they always have been a strength for India. But again, they are now flowing more and more directly into equity markets. So I think all of these are important. And then you look at global factors. For instance, again, everything is at the end of the day, like in stock markets, as you know, is comparative. So one, of course, is that we are doing reasonably well. But more importantly, now we're doing very well if we were to compare with what's happening around the globe. You look at, again, factors like China plus one strategy, what impact PLI has. So I think there are a lot of factors which are contributing to the growth momentum that we see. Lastly, I think it is the quality of investments. In the last round of investment cycle, it was, to my mind, possibly irrational exuberance. Now you have companies which have deleveraged, a lot of growth is coming from companies which are pretty strong in their sectors. So it is not only that we have growth, but the quality of growth, to my mind, is very good, which augurs well for the banking system too.
Great. So let's look at some absolute numbers here. We've really painted the big picture for us very nicely for the benefit of our viewers. I want to understand the ROA for BOB. If I compare that with private banks, there is a long, long way to go. But if I compare where you were versus where you are, 0.6, 0.7, you've come up a long way. In next 2 years, where do you see your ROA will settle? Because, sir, if that settles, I'm just saying for the benefit of our viewers, that would be the big J curve or the big trigger for you.
Yeah. So I think to some extent, the depressed ROA of the last few years was on account of where we were in the corporate credit cycle. Now, as you would be aware, that for BOB and a lot of banks like us, corporate loans are 50% of the portfolio. And corporate credit costs were at a time more than what your net interest margins were. Now, corporate credit costs have been trending down significantly, and even right through the COVID cycle. It is my assessment that these credit costs will continue to trend downward. So I think that is going to be the biggest driver in terms of improvement in ROA. The second part, of course, is that in the past, you had the template that in case you want to grow, you add more people, you add more branches, and therefore you might say that the operating leverage was fixed in so many ways. Now, that is, to my mind, something that has changed dramatically. So now you have growth. For instance, again, our loan book grew 18% YOY last quarter, but this is not based upon investments in the physical infrastructure or in manpower, which is again of the same order. For instance, today, as we speak, we have fewer people. In fact, we have fewer people as compared to where we had even 2 or 3 years back. Our branches are maybe 10-15% less. But in terms of the outreach of the bank through instrumentalities like business correspondents, I think that's gone up tremendously. But more than anything else, what makes it possible for you to grow your business without investment correspondingly in physical assets is the digitalization that we have seen. So in a period of 1 year, we launched Bob World about 1 year back. In a period of 1 year, we have acquired something like 22 million customers on Bob World. Right? So that if we look at a non-FI customer base, that's nearly 40%. About 4 times as many customers use Bob World every day as compared to those who come to our 8,200 branches. Now, this is a trend which is growing by the day. It has enormous implications in terms of cost of servicing customers. It has enormous implications in terms of customers having access to you. And that means that you can have quarter on quarter of significant growth without having a corresponding investment in the physical infrastructure. So to my mind, that is the most powerful factor which will continue to play out in the times to come. And the banks, and I hope BOB is one of them, that have used the time of the pandemic to make the right investments in digital infrastructure and made sure that that digital infrastructure is brought to bear for the benefit of customers will benefit enormously. So therefore, to my mind, 2 factors. One is credit costs coming down. And number 2, again, the fact that growth is not going to be powered by an equal increase in costs. I think these are 2 most important factors.
Just to wrap it up with one very basic question, something which we also asked the finance minister and to the RBI governor, which is that if you look at credit growth, according to your numbers, it would be in mid-teens. But if I look at deposit growth, the deposit growth is in single digit. How are you likely to match that gap? Does that mean deposits rates will go higher or your margins will start getting compressed?
So I think we have to again see it in a context of last 3 or 4 years, right? So there was a time during the pandemic where all of us were challenged in terms of loan growth and deposit growth was there. In fact, we used that opportunity to make sure that the quality of growth was very good. So our CASA ratio moved up from 2019 at 37% to more than 44% now, right? So that has been a permanent improvement in the quality of the deposit base. Now, as I said, this is a time when the economy is recovering, right? And therefore, it is quite natural that you might have a few quarters where advances growth should run ahead of deposit growth. In fact, that is something to my mind which is positive. Having said that, I think it is also true that because of the fact that interest rates were negative, there was again trend of savings moving away from banks over the last few quarters. Now, with interest rates correcting, and I suppose at some point in time in the cycle, we'll have positive interest rates, that's a trend that should get reversed. So I would not really read too much into the fact that there will be a few quarters where advances growth is ahead of deposit growth, because the reverse was equally true in the quarters before that.
Okay, Mr. Chadha, hi, this is Anisha also joining in the conversation. Just before we let you go, also wanted to understand from you this credit growth that we have been talking about. Is it getting fueled by the capex demand, or this is the working capital need, given the fact that commodity prices were higher, a lot of businesses needed higher working capital loans? Is it changing towards more capex oriented now?
So I think the demand for us has been very consistently coming from the retail sector. I would expect that will continue. Now, within the corporate sector, it has been the investment demand, which again, to my mind, is for the moment the primary factor. As far as higher commodity prices are concerned, and therefore, again, a change in terms of working capital demand, to my mind, that has not completely played out. I think there's still scope for that to improve credit offtake going ahead. So, for the moment, I would look at the increase in working capital utilization as a potential upside, which we have not seen the full impact of.
So further upside possible from that working capital push that we might be seeing. Thank you, Mr. Chadha, for joining us today. Really appreciate your time and speaking with ET Now.
Thank you.